The other thing that you could focus on are at least 15% of the exam or so, thereabouts, is going to be definitions. So go through the text and you'll see as you go through it, when you see those highlighted, let me just show you here, highlighted terms. If you click on it, it pops up a little window with the definition. And make sure you're able to differentiate between two relatively close definitions. So as kind of a really easy example, but still nonetheless, say the definition would be the right but not obligation to sell the underlying asset. So the two obvious choices would be either a call or a put. So make sure, and by the way, both of those terms will be on your list of terms, right? So make sure that you're able to differentiate between those two. I'll give you probably twice as many terms as there are definitions. So you won't be able to get down to the end, like I've had some exams I've taken, and say, oh, well, I don't know this one, but this is the only term left, so it's got to be. No, you'll have another 15 or 20 terms. Make sure you know those fine differentiations. Obviously,
That would be a call, right?
Pardon?
That would be a call then, right?
I was going to say, let's see, I think I said
Obligation, right? I
the
mean,
the right but not obligation to, did I say sell? I think I said sell.
or what? I think it was a call or a put.
Yeah, right. And if it's sell, it would be a put.
Oh, it would be a put. Okay.
Yeah, yeah. So that's the kind of thing to go through. It's just going to show you if you're in your text here. Let me just go to where I was. Go back here. Yeah, here at the very end of the chapter, you can see the various definitions in there, and you can just click on those. And I believe that they have those also linked. I thought they had them highlighted in the chapter itself as well. Maybe they've changed it. It used to be that you could just press on the term itself. Here it's at the end. Oh, here we go. So if I do that, then it gives me the definition of that term. So I would go through each chapter and make sure that you're really familiar with all those definitions that are highlighted, because those are the ones I'd focus on the exam.
Okay, and you said 15% of the exam will be terms and definitions.
Yes, at least it might 15 to 20ish, depending on. I haven't made the exam yet, so.
And you said it was all multiple choice. Like we'd have to find like the numbers and things, but they're going to be
Yeah.
just okay.
Yeah. Now, of course, I just like with the matching. I love the choice E, which is all of the above or none of the above, that kind of thing too. So, again, make sure that you're really solid on it. You're not going to be able to eliminate A and B and then go, well, it's either C and D. It'll probably be either C and D or E. So. And for that sort of thing, go through the homework. I would say about half of the multiple guess are going to be analytical type things. They're going to be like problem solving, and the other half will be more conceptual / definitional type of things. And you had the same sort of mix in the homework, right? So you had a series of conceptual stuff, 5 or 6 out of the 10 or 12 that were conceptual, and then the other 5 or 6 were numeric.
Yeah.
Know the difference between what the residual income model is versus DDM versus free cash flow, that sort of thing as well. And let's see, the various now, chapter 5 is just full of terms, right? So, you've got primary market, secondary market, third market, fourth markets. You have primary securities, secondary securities. Do the primary securities trade in which markets? So make sure you go back over that and have that stuff fairly clear, or as rather, I should say, as clear as possible. I know it's pretty much as clear as mud in many regards. A lot of these terms were kind of evolved with the structure of the market. So this third and fourth market were inventions of later on down the line. We had primary markets and secondary markets. This primary market is a market in which the security first trades. So when the security goes from the company to the individual investor, and the cash goes back to the company, that's a primary security. That can be a primary or a secondary security trading in the primary market. And then when it's one investor to another, that's a secondary market and a secondary security. So, go back through those sorts of things and make sure that you're clear on how those things relate to one another. I would say that chapter is full of the most confusing terms. Chapter 6 probably has the most difficult concepts. Let's see, forgetting whether it was chapter 2. Chapter 2 is where we got into, the margin and the short sale stuff. And that stuff is typically difficult too. And then the options out of chapter 3. So those are the areas that I think students in the past, at least, and I know myself when I learned this stuff, those are the areas that I had the most difficulty with and that the average student has the most difficulty with. So I would go back over those to make sure that I'm comfortable with that stuff. A lot of the rest of it, like out of chapter 19 and 20, those are things that you've probably seen elsewhere. So this is a second or third exposure to it. So that should be a little easier. I'm not saying exclude that stuff from your study, but I would say, if I were working on it, I would make sure that I had the more difficult material down pat, and then I would go back over the other material that I had already learned, or at least was somewhat familiar with from prior classes.
I'm sorry, can you repeat what you said in chapter 2? Chapter 3 said, like, the
Mm-hmm.
options.
Right.
Chapter 2 is...
Chapter 2, I think the more difficult material out of there would be the margin long positions and the short positions, and figuring out what the margin is, what price you'd get a margin call at, and what's your return on your investment. And remember, when you're doing that return on investment, it's the return on what you invested, not the return on the entire position. The entire position is leveraged, right? Because, for instance, in the margin long, you put up half the money and you borrow the other half. So the denominator in your return formula is the amount of money that you put up. And then the numerator, of course, is the profit that you made off of that, or profit or loss that you made on that position. Any problems in particular or applications that you want to look at?
No, not really. Just sort of more generic questions. So, sorry, how long is the exam again?
I'm making it to be an hour, 15, hour and a half. I'm actually, since we're not doing anything else that Tuesday night, I'm going to give you the whole class period to work on it,
Okay.
which will be way more time than you need. I know some people like to take their time. Inevitably, I'll have one or two folks who end up taking the whole time. I wouldn't necessarily advise that, because sometimes that ends up being, I don't know if there's any correlation, but oftentimes I find that if you end up taking all that time, the grades tended to be lower, which seems weird, but so I would just work at your normal pace. Don't try to second guess yourself. I've always, again, from personal experience, I found that when I start second guessing multiple choice questions, inevitably my first guess was probably my best choice. So, but you'll have plenty of time to finish up. And you'll have the formula sheet, so make sure you printed that off. You'll have access to a calculator. Um, the camera app is going to scream at you saying, hey, you're looking down. Don't worry about that. I mean, it does record it for me, but I know that you have a formula sheet and a calculator, so um, just try to ignore that. I've never been on the student side of that. What does it let you know, hey, you're averting your eyes too much? Yeah.
Sometimes with the lighting too, it'll say like you're not in frame, and it's like I haven't moved.
Yeah, right. I'm
Have
still
like a
here.
general? I know you said you haven't made it yet, but do you have like a general idea of how many questions you want?
I don't. Let's see, on the definitions, I usually try to have, they're usually worth about 1 point, so there'll be 15 plus or minus a few. Let me see if I've got an exam here handy. Yeah. 62 including the matching will be a single question, right? Worth 15 to 20-ish points. So I had 61 multiple choice questions. So you have to move quickly. And obviously some of them, about half of them are conceptual, definitional type of things. The other half are problems, and so you can probably get through the definitional and conceptual ones fairly quickly. You won't need the full minute plus to do those, and then that'll buy you additional time to do the calculations. And for the most part, the calculations, let me go back here. The calculations that I had on there, were very much like the homework problems. Obviously, the numbers are going to be different, but in general, like the homework problems. Does that help? So you won't be surprised.
Yeah. Okay, so 60 questions, 61, 62 questions.
Yeah. Yeah, and that last question is, we'll have 15 to 20 terms, so that's really totally, including the matching, there's something like 75 plus.
Did I miss anything this week, Dr. Elliott? Because I didn't see anything on the dashboard. You just wanted us to study this week, right?
Yeah. Oh, for this upcoming week?
For this past week, sorry.
Oh, the past week. Did you go to the YouTube videos?
Yes.
Okay. And let's see, what was our last assignment there? Let me go over to Connect. Let's see, day 2.
I just wanted to double check. I didn't miss any lectures this week, right? I mean, we didn't have.
No. In fact, that's what the videos were for, as a replacement for the synchronous lectures. Yeah. Yeah. No problem. So, I mean, you did the reading for chapter 5, and then the 2 homeworks.
Yep.
Okay. Yeah, and then day 5 was chapter 20 and chapter 6 and 19 homeworks. So if you did all of this, then yeah, you're set.
Okay. Just wanted to make sure.
Mm-hmm. Yeah, and there should have been 2 videos for each. Tuesday there were 2 videos. The first 2 parts of chapter 5, and then Thursday the last part of chapter 5 plus the pro forma stuff, that little hour thing on developing a spreadsheet for your security analysis.
Yeah.
Okay. So let me open it up. Any questions? April, Alex, Matthew, Joe, Alan, anything that you had in particular?
I guess just a general thing. Are we able to go back and look at our old homeworks?
You are. Yeah.
I went in there, it just gave me a report about how well I did on it, but I couldn't look at any of the questions.
Oh, really?
Yeah.
Let me see if I can. Hell, I
I went to
thought.
Canvas and I went to like assignments and I went like through grades. I was able to click it and it linked through and I like went through the homework.
Oh, great.
Oh, that got you back into it?
Yeah.
Oh, good. Thanks. Thanks, April.
Yeah, I would just click on the day and then like see report, and then it would give me all the homeworks. And then if you click, or at least for me, if I clicked on the homework, I use a Mac. I don't know, maybe the different operating system.
Yeah, I was thinking go to like I don't know if you guys have preview choice there. I think I've got a way to look at this from your perspective. Let's see. Where is it? Where is it? Ah, here we go. Student view. So is this what you're getting, Alex?
I guess I was going through the modules or the assignments tab, not the McGraw-Hill Connect page.
Okay.
So maybe I need to try that.
You should be able to get to it this way as well. So, for instance, chapter 6 should take me there. And you could try that out right now and see. April, say again how you got to it this way?
Yeah, I think both ways, but right now I was able to do it through Canvas. I clicked assignments and I could click each one. Then it would take me, I had to like click connect and like go through it.
Mm-hmm.
Click like through the past assignments.
So I get to past assignments and then I'll click homework chapter 5, let's say. And then it just directs me to yeah, it directs me to McGraw-Hill, and then it gives me all of them again in a list. And then I'm only able to see my attempt, and it just gives me, oh, now it's working for some reason. Before it wouldn't let me get into the actual homework.
Oh, okay. Okay. But now you're getting into it?
It looks like it.
All right. Good. Thank you, April.
Thank you.
Anything? Yeah. So feel free to go through those, and remember if it says, hey, you got to do this all the way through, or get a lower grade, the assignment's already been turned in. So, and even if you only got a 70 or an 80 on it, I round all of those up to 100. So don't worry about going in there, and it shouldn't affect your grade that's already in the system. Anything? Oh, go ahead.
I have a couple homework questions that I wrote down.
Okay.
If that's all right.
Yeah, absolutely.
The first one I have is chapter 2, number 14.
All right. Let me get back there and go to chapter 2. So that must be like a
It's the
margin.
Yeah, it's the margin, and it's dealing with I believe margin call price, but it's for a short.
Okay.
What?
So you short sold 1,200 shares of stock at a price of one, and these numbers are probably going to be different from what you had, right? Because it's a algorithmic problem. It's going to throw different numbers up, but the basic process should be the same. Let me get a chunk of paper out here in the calculator, and let's take a look at this. All right, so we got 1,200 shares. Oftentimes, too, a shortcut could be they may give us 1,200 shares, but if we do this on a per share basis, it depends on what they're asking. We may end up with the same with a easier set of numbers and the same answer. So we got 1,200 shares of stock at a price of $30. Initial margin of 75%. So we're borrowing 25% effectively. If the maintenance margin is 30%, at what share price will you receive a margin call? What is your account equity? Okay, so margin. call price, and account equity. All right, so let me shift over to here, because here I can do a blackboard thing. So that's our starting point. Now, as I was, the direction I was headed is you could do, you could calculate what it is by actually using the same formula, but realizing that your initial deposit plus the proceeds from the short sale minus the number of shares times the current price, and then you divide that all by number of shares times the current price. And what we'll know is we'll know that we know what our initial deposit is. We know what proceeds we earned on the sale of that stock. And then we also know how many shares we've got in it. And so those are all known, and we've got this one unknown, and we could solve that way. That's one way of doing it. I think a simpler way is to just take the formula that's already been calculated for us for P star and make sure that when you pick the formula, look on the formula sheet, there are two sections there. There's one for a margin long position, and it has a P star formula. There's another section right below that, though, for short positions. It too has a P star formula. Those are different formulas. So make sure that you use the proper formula. So this is a short position, so we're going to use that second formula. So that's P star is the initial margin deposit plus the short sale proceeds. And then we're going to divide that by the number of shares. And all of that gets divided by 1 plus the maintenance margin. Okay, so let's figure out what our initial margin deposit was. And that one is actually pretty simple because we deposited $22.50 per share. So we could choose to do this either on a per share basis, or we could use the entire 1,200 shares. So let's just use the 1,200 shares for right now. So we've got $22.50 per share times 1,200 shares. That's $27,000. So we deposited $27,000 with our broker to open the position. Now, when our broker short sold those shares, so the broker is going to go out, they're going to borrow those shares from another investor with the promise to repay those shares later on. So they borrowed 1,200 shares. They turn around immediately and sell those shares into the marketplace at $30 per share. So that's going to generate 1,200 times 30. That's going to generate proceeds of $36,000. And then we're going to divide that by our 1,200 shares. Stop me if you've got a question too. And then we've got our maintenance margin was 30%. So 1 plus 0.3 would be 1.3. And then let's put the 36 together with the 27. 63,000 divided by 1,200 all over 1.3. So I've got 52.50 divided by 1.3. And that gives me $40.38.5. We're just rounding off to the third decimal place. Does that make sense?
Yes, thank you.
Sure. Was there a spot in there that threw you, or?
Yeah, I was able to, I think I wasn't, the account equity I was struggling with, and then I now see the short margin versus the long.
Right. Definitely go with that. Yeah.
That helps a lot.
Yeah, and remember, you're in this case, you're putting in money that seems like it's in addition to the position, right? Because theoretically, couldn't the broker just borrow those shares, sell them into the marketplace, and generate that $36,000, and that becomes your account equity? But if they did that, you would have nothing in it. So your account equity would effectively be zero. You would have no equity stake in it. So that's why, since you're doing a 75% margin, you're putting up an additional $27,000 of your own money. So now that part of it, that initial margin deposit, is your actual account equity at the time you open the position. So in fact, this is probably a good thing to look at too. Let me jot down these numbers just so I've got them. 27,000, 36,000, and okay, our 1,200 shares. So a thing I like to do is to look at this as a T account, right? So we've got assets, liabilities, and equity. So on the asset side of this, remember, this is, because it's a short position, the asset is denominated in cash. It's the liability that's denominated in shares. So let's write the asset as it's $27,000 that you put in, and $36,000 that was generated as a result of the sale of the stock. And so that's 50s. What did we come up with? 63,000. So there's a total of $63,000 in cash in that account on the asset side. The liability are those 1,200 shares, and it's important that you remember that that's the denominated in shares. We can calculate the dollar value of that right now simply by multiplying by the current price. So that dollar value is 36,000. And then, so of course, assets minus, so 63 minus 36 is our equity stake of 27. So, and those two together add up to 63. So our balance sheet balances. Now, as the price of the shares changes, that's when, so this number is going to change. Remember, the cash on the asset side, it's not going to change unless we get a margin call and we deposit more cash. Then that will go up. But short of that, that dollar amount it's denominated in dollars, so that dollar amount is going to be fixed. So all the action happens over here as the value of the shares changes. As it goes up, the value of your equity obviously goes down. So as this goes up, the value of your equity will go down. If the value of the shares goes down, the value of your equity goes up. All right, and that's to be contrasted with the margin long position. So in that case, in the margin long position, it would be, and let's say we did the same numbers. So let's say we did 1,200 shares. So in this case, this is where the asset is denominated in shares. We can get a dollar value for that by multiplying by the current price. So we could actually set that up. And if we did the same margin, 75% of our own money and 25% that we borrowed. So in this case, that would be, we'd borrow $9,000, and we would put up the 27,000. So that's the liability, that's the loan in dollars, and then this is our equity stake. And so between that adds up to 36,000. So that would be the same setup if we had done a margin long position. But notice here how, over here, our total value of our assets is 63, whereas if we did it as a margin long, the total value of our assets is only 36,000. So don't let that confuse you. It's just, that's how it is, right? Because of the fact that up here in the short, we're borrowing shares. So we really don't have any of our own money in those shares. We actually have to just give cash to the broker, and they're going to put that cash into an account with our name on it. Over here, we're borrowing dollars, adding to that our own dollars, and then using those dollars to buy those shares. So that's why we see this big difference between the two account balances, whether we're, this is our short, and this is our margined long. So sometimes if the formulas are, there's not a lot of intuition in those formulas, but if you set it up as a T account, it's hard to go wrong on that. You could even, if you didn't want to use the price formula, you could start changing the price and recalculate using these T accounts, kind of just increment. You know that in a short position, price going up is moving against you. You're losing. So that's the direction that would move you towards a margin call. In the case of the margin long, price going down is where you'd lose money. So you could start changing these figures. Instead of 30, try $25 try $35 and see what you got. And down here, instead of 30, you could try 25, and keep changing those prices incrementally. If you didn't like that pricing formula, that P star formula, you could certainly do it this way. You've got the time, but it's up to you as to what works for you.
Got it. Thank you.
Okay, sure.
How long do we have? Do we have the whole class period?
Yeah, I'm going to give you the whole class period. I think you guys came in after I mentioned the last time I made up this exam. We had around 60 multiple choice questions, about half and half conceptual and then problems. And then we'll have 15 to 20 definitions, and you've got to match the correct term to those definitions. But, if you're moving along, that's about a minute per exercise. The conceptual ones you'll probably spend a lot less time on. So there you might get it done in 15 seconds, 30 seconds. That gives you double the time effectively for your problems. And then usually the problems, they're going to look like homework problems and like the problems that we saw in the applications.
So everything will be multiple choice or fill in the blank, basically.
Correct. It'll be somewhere in the neighborhood of 60 multiple choice, and then 15 to 20 matching.
Okay, gotcha. So matching, yeah. Okay, that makes sense.
Mm-hmm.
I had a question that was kind of simple.
Sure.
This was the first application of chapter 5 and 6.
Uh-huh.
So I was looking at the formula, and I was just wondering, okay, I don't know if there's any way to just bring it up for a second. So I don't know why, I was just wondering, because it shows, RM minus RF, and almost like we don't even subtract RF in that equation. So I was just wondering why we didn't.
Oh, okay. Yep. That has to do with what we were given, whether we're given the risk premium, the market risk premium, or whether we're given the return on the market, I think. Let me get to that file, but just so that I can confirm that.
I missed that on the sheet. Where is that formula on the sheet? Like the formula sheet?
Oh, for what?
For that, like that equation, where is that on the formula sheet? I don't know if I just missed it too.
Let me go see. Well, let me pull up that application first. So this was out of
5 and 6.
5 and 6. Here we go. Let me just make sure it's what I was thinking it was. This one right here?
Yeah.
Okay, so yeah, you're given information off the value line page. We're looking for K, assuming that the risk-free rate is 3.75% and that the market risk premium is 7%. So this formula, the way this formula on the first line reads, that's what we call the market model out of the capital asset pricing model. So this is CAPM for all intents and purposes. The way it's generally written is like that first line. The thing is that R sub M is the total return on the market. R sub F is the risk-free. The difference between those two is called the market risk premium. So since up here we were already given the market risk premium, you don't have to do that subtraction. So the key thing, when you're reading a problem, and you'll see this in the homework and or certainly on the midterm exam, you'll see you're either given the return on the market or you're given this market risk premium. So if you're given the market risk premium, that's already subtracted out that risk-free rate. So the return on the market in this, we could calculate the return on the market. That would have been 10.75%. So if I subtract off that risk-free rate, then I get back to that market risk premium. So yeah, sorry, good point, because I hadn't we didn't work through these in class, and I would have mentioned that in class, and but I didn't mention it on the slide deck itself. So sorry about that.
Thank you.
Sure.
I just have a basic question too for the exam. So are we supposed to log in on Zoom for the video, or like?
No, when you go into the assignment will show up. I'll have it ready to go. I'll flip it on 5 or 10 minutes before the test starts up. By the way, I'll send out an email tomorrow, just kind of giving everybody a little more detail and kind of reiterating what I've said. I'll post this video and that sort of thing. But you'll have access to it a couple of minutes before the actual start time. That'll give you the time to get into the exam. What do they call it? Respondus is the video thing. So you'll do the scan of your workspace, and then you'll get started on it. And so you don't have to go into Zoom. You would go straight to assignments, and you're going to see that right down here. I haven't actually, this is what I did is I copied the spring class over. So right here you see the spring exam. But this isn't published, of course. But what you'll see is midterms summer 2021, and you'll click on that and it'll walk you through the steps. So make sure that you've got your camera set up and that sort of thing ready to go. But have you ever used the lockdown browser before, April?
Yeah, I thought I had to download something different. I have a different computer, so if you
Oh.
download everything too.
Well, you know what I think you can do. Let me go to student view and make sure that you can do it this way. No, it doesn't look like you can. What I was going to say is that when you go to lockdown browser, There are a bunch of, they have some tutorials here. And maybe what I need to do is, let me figure out if I can get you the link to these videos so that you can just walk through it ahead of time. I'll try to get that set up and add that to that announcement. Let me make myself a note to. Sure. That way you can have your computer set up and ready to roll. All right. I will do that. But yeah, that way there's a video about the lockdown browser and getting that set up, and then the Respondus monitor thing, which is the video deal. But you won't have to log into Zoom. By the way, in that same announcement, what I do is I'll leave you my cell phone number. So should something happen, your connection goes bad, anything, make sure you call me right away. And then that way, or text, whatever works. And that way I can try to solve the problem. Like I said, I'll be monitoring. And if you get locked out, if it's just for a second, sometimes if somebody's phone rings and it's connected to the computer somehow, it'll lock you out. If I see that, I'll flip you back into the system. I'll approve you to go back in. Or if I don't see it right away, just feel free to text me or call me on that cell phone number, and that way I can give you permission to get back into the exam. That happens fairly, frequently. So I figure that's the easiest way to manage that, and that way it, protects you too from getting locked out and then not knowing what to do.
What's the weight of the exam itself, Dr. Elliott? Is it like how many points?
Out of the entire class, 25%.
Okay.
So that between the final and the midterm, it's half the grade.
Okay.
And then the other half is made up of the Learn Smart questions, the homework questions, and the security analysis. And there's a small piece for attendance too. Hey, welcome, Brandon. Sorry I didn't see you when you popped in there.
Yeah, was this meeting supposed to be at 2 or 1:30?
Well, I kept shifting times. I apologize. I started at 1. So.
Oh, it started at 1. Oh,
Yeah.
I thought
They
changed it 2 or something.
Yeah, no, I apologize. I kept messing up my schedule.
Oh, okay.
Do you have, let's see, did I answer, let's see, Matthew, we were working on your question, then April. Did I take care of all of that? Your questions? Okay. Brandon, if you have questions, feel free to jump in.
Okay, yeah, I was just, going to listen to, I'm still studying, so I'm going through it. I'm going to listen to if anyone else had any questions, but I guess I joined in a little bit late. I actually had the same question I think April asked about the lockdown. I joined in the middle of the conversation. You said you were going to add something to the announcement?
Yeah, I'll get the links to these videos so that you can just kind of get up to speed on what you need on your computer. Honestly, I'll have to look at them again too, because I looked at it initially and then I haven't gone back to it in a while. And since I don't have to install this thing, it's you guys. I haven't. I didn't remember it. My computer skills, if I don't use it, I usually lose it. So it's. But I'll post these links for you guys so that you can look at that ahead of time and make sure your computer system is set up properly. Just make sure you've got a camera connected in there too. What else, Matthew?
Go over the retention ratio and
Oh yeah.
what it used for.
Yeah. So let me go back to. Would it be easiest just to look at the formula sheet?
Yeah, that might help. Yeah.
So let's see. Where was that? We were calculating growth rates in chapter 6, right? Right here, you're thinking about this right here as sustainable growth rate?
Yeah.
Okay. Yeah, so the retention ratio is simply 1 minus the payout ratio. And let me go back to here and, oops, what happened? Lost that. Come on. So sustainable growth is equal to the ROE, return on equity, times the retention ratio. Now, the retention ratio is 1 minus the payout ratio. Basically, the payout ratio is dividends per share divided by earnings per share. You could do that, so that's on a per share basis. You could do that, you'd get the same thing if you just did aggregate dividend payment over aggregate earnings. And obviously this aggregate earnings is net income, right? So you could either way would get you the payout ratio. So basically the retention ratio, which is this 1 minus that, it's what percent of earnings does the company keep inside the company for future expansion and investment. All right, so that's why. So when we're up here talking about retention ratio times ROE, well, think about it. If I have, let's say that I have $1 worth of equity in the company this year, I earn. Okay, let me just write it out like this. Equity. Let's say I earn 10 cents per share. And I pay out 5 cents in a dividend. So that means that I have retained 5 cents per share, and I have a retention ratio of 5 cents that I kept, or 5 cents that I paid out, and then the 10 cent earnings. So 1 minus that leaves me with 50%. Oops. Leaves me with 50% retention ratio. So here's the thing about that retention ratio, and as it relates to sustainable growth. So if I just had the dollar and I paid out the entire 10 cents, my next my growth would be effectively zero between this year and next, right? Because I still just have that dollar's worth of equity. But because I didn't pay out the entire 10 cents in a dividend, I have 5 cents. So next year, I now have $1.05 instead of just $1. Then that means that $1.05, or that in particular, that 5 cents, times how much return I get on each dollar I have invested, that's our ROE, that's going to tell me how fast the company can grow. So at the end of next year, I start at the beginning with $1.05, but at the end of next year, I'm going to have $1.05 times the ROE. So that 5 cents times that ROE is how quickly the company grows. So you can think of it that way. I don't know. Did that get at your question?
Yeah. So it's like kind of like retained earnings, but in a ratio, sort of. Like,
Yeah. You can think of it exactly. It's the percent of earnings, total earnings, that I have retained. Yep, absolutely.
Thank you.
Sure. Oops, come on. There we go. What else? April, did you have something?
Yeah, it's not like an actual problem. It's just I was wondering where this was on the formula sheet. So it was
Oh,
chapter 5 and 6, the applications, and it's question 5 for application 5, and it was for the relative valuation technique. I was just wondering where that formula was, unless I was missing it.
oh, let's see. Let me go back to that. Application 5 and 6. Oops. Oh, here we go. Okay, so you said the fifth one?
Yeah.
Right here?
Yes.
Okay, so now we're going to use relative valuation using the PE ratio from the years 2014 to 2018. Let's assume that the growth rate of earnings is the same as we just estimated. So what we did back here, and where do we have that? 10.95%. Okay. And so, yeah, now the formula for the relative valuation stuff is, get over here, grab that formula sheet again. Should be right here. So if you're using PE, this would be the historical, the top row there, historical PE ratio times the current EPS plus 1 times the EPS growth rate. Oh, come on. I don't know why this thing keeps... so that's where we're getting... so we're calculating the... I wish I could start writing on this. That's not cooperating. Let me just do this by... So here in this first line, you're calculating that average historical PE. So that's from 2014 to 2018. So this 16.2 would be 2014, 14.5 for 2015, 11.3 for 2016, 14.4 for 2017, and 13.8 for 2018. We've got 5 years, so we just divide that by 5. We come up with 14.04. So then that third line right here, the value of the stock is equal to, I've flipped the terms around a little bit here, but basically it's the same thing as what you see here. It's the historical PE times the current earnings times 1 plus the growth rate. And when we do that, so here's our historical PE is over on the far right, times the current earnings, EPS 0, times 1 plus the growth rate. And then plugging our numbers, our current earnings were $9 per share. The growth rate was 10.95%, so 1 plus that is 1.1095. And then times our historical average PE. And that gives us 140.196. Now, why is that the case? So if you think about P over E, that's really price over EPS. And if you have, so when we come up with this value formula, we've got our historical PE times EPS times 1 plus the growth rate. And so our historical PE, what do we have there? 14.04, is that right? Times our $9 times 1.1095. So 14.04. And then this becomes 9 times 1.1095. So that's 9.9855. Now, remember, this is, let me just put it up above here. This is EPS 1. So that's next year's EPS. This is the expected multiple, that is price over earnings. That's the expectation that we, the way that we'll value that dollar's worth of earnings. So each dollar's worth of earnings will be valued in the marketplace at 14.04 times that $1. So if we look at this, just over here, P over E times, and by the way, that's EPS, right? Times EPS. EPS cancels, and we're left with price. So when you do this multiplication, what do we have on that? What do we finish up with that? Oops, I'm in the way now. So if you think about it this way, you end up with just price. Let me just do the multiplication right here, since I don't recall the number offhand. So we had that $140.19 and a little more than a half a penny. Does that help? Does that answer your question? Okay, sure. Now, and remember, we can use the historical PE for the firm itself, or we can use the PE for comparable firms that exist right now. We can look at their current PEs. Both methods are effective. In fact, in the real world, what you're typically going to do, though, is to not look at the historical PEs, because part of the reason for using a relative valuation model is that most investors, most analysts think that the market changes its valuation on a dollar's worth of shares from time to time. So if we're looking backwards, we're looking at how the market valued it a year ago or 2 years ago. What we really want is to use those comparables and look at the cross-section and how they're looking at it today. But both methods are reasonable. In the first case, we have a better comparable because it's the company itself, but a very lousy forward-looking measure. And in the other situation where we're looking at comparable companies, we don't have as good a match, but we're at least looking out forward. So hope. And you can do this for price to cash flow, price to sales, and you've got the formulas for each of those. Oops, where was that? Right here. So there's your price to cash flow right there, and then there's your price to sales. But basically, it's the same idea. Okay. What else?
Could you go over chapter 6, number 10?
Sure. In the homework?
Yeah, in the homework.
Yeah, sure. All right. This seems to be hanging. Let me try getting in. There we go. Now we're working. Number 10. Okay, so you've been tasked with using the free cash flow model. And remember, in these examples and in the stuff, this will be the same on the midterm since this was out of your homework. In this situation, when we're talking about free cash flow, we're always talking about free cash flow to the firm, which means we always have to remember we've got to pay debt too. So that free cash flow value is going to be the value of the equity plus the debt. So if we're actually trying to get to the value of the equity, right before we get to that, we've got to first subtract off that value of debt. So we're going to use free cash flow to value Julie's jewelry. After your initial review, we find that Julie's has reported equity beta of 1.7. So, and again, since we're valuing the firm, not just the equity, we know that we've got the equity beta. We're going to have to figure out what the asset beta is. But we've got a formula for that as well. Let's see, we have a debt to equity ratio of 50%. So half of the assets are every dollar's worth of equity is matched by 50 cents worth of debt. We have a tax rate of 21%, so 0.21. Market conditions suggest a risk-free rate of 6%, 0.06, and a market risk premium. So again, here we're going to have R sub M minus R sub F, that's our market risk premium, of 11%, so 0.11. And Julie's free cash flow from last year, so that's free cash flow sub zero, is 50 million. Current debt is 125 million. And find the value of Julie's equity, assuming a 3.5% growth rate. So the growth of free cash flow is 3.5%, so 0.035. All right, so I've got all those numbers jotted down. And first thing to do is to figure out what the asset beta is so we can figure out what the correct discount rate for the earnings on the asset base is. So actually, we can just go down here. That's let me go to the formula sheet here. I think I've got the formula sheet sitting in here rather than bouncing back and forth. Yeah, here we go. Okay, so right here, this is our formula. So all they're doing here is they're saying, well, wait a minute, let's, instead of solving for the equity beta, we're going to solve for the asset beta. We know the equity beta. And so we're going to take that 1.7 and we're going to divide by the thing over here in the brackets. All right. So that's what they're doing right here. So there's the 1.7 divided by that mess in the brackets, and we come up with a asset beta of 1.22. And again, just kind of a quick back of the envelope check. Your asset beta, as long as you have leverage, your asset beta is always going to be lower than your equity beta. So if you get an asset beta that's higher than your equity beta, you know you made a calculation error. So go back and check yourself. So again, some of these little tricks to think about things will save you from making errors, or at least perpetuating that error. Next thing we do is then to use that equity beta, or excuse me, use that asset beta to calculate our required rate of return, our discount rate, our K, whatever you want to call it. It's all the same thing, right? We know that our risk-free rate is 6%. We have a market risk premium of 11, so we don't have to subtract off the risk-free. That's already taken care of for us. If we were given the return on the market, in this particular example, we would have been given 17%. So we would have had to have subtracted off that 6% risk-free rate first to get to the 11% market risk premium. And that goes back to the question, April, you asked about earlier. Same sort of thing here. Just be very careful. Look carefully at which return you're given, whether it's the market risk premium or the return on the market. If it's the latter, always subtract off the risk-free rate first and then multiply by the appropriate beta. In this case, that's 1.22. We get a K of 19.41%. Right? And then it gets, that's kind of the messy part of it. Then the rest of it is very much like that dividend discount model, or like the residual income model, same, assuming constant perpetual growth. So we set it up, the numerator is next year's free cash flow. Instead of in the dividend discount model, that would have been next year's dividend. In this case, we're using free cash flow, so it's the 50 million, and they're just saving some saving some zeros here by putting it in millions of dollars, times the growth rate. So that 50 million is free cash flow times 0. If we multiply that by the expected growth rate of free cash flow, this will give us the value in the brackets will give us the free cash flow at time 1, at the end of year 1, so next year. And then we're going to divide that by K minus G. So K is, of course, that 19.41%, and G is 3.5%. And when we do the math, that gives us a total value of the firm of $325 million. But remember, this is free cash flow to the firm. So before we get to the equity value, we always have to subtract off that 125 worth of debt, and we end up with a little over 200 million for the value of the equity piece of it. Does that make sense, Alex?
Yeah, I didn't get the correct K. I didn't add those together.
Ah, okay.
I think I was just using the risk premium and
Multiplying by beta and not adding the risk-free.
I think so. Yeah, I didn't add all three together. So I think that's where I went wrong.
Well, and remember, notice this, the first one is addition, but the second is multiplication. And do that first, obviously, the order of operation, right? And if you look over here to our, where do I have it? Calculating K. Thought that was in here. Oh, wait a minute. You know what? I think in your the formula sheet I uploaded should have the cap M in there. Let me just double check that. That's weird. That one I brought up out of the file doesn't have K in there. I want to make sure that that's the formula sheet I uploaded is the proper one for you. Because it should be at the end of this list of items. Huh, weird. Oh, here we go. It's right here. So there's your discount rate is equal to the risk-free rate plus the beta times the market risk premium. Would you like to have that set up a little differently? I could write that as K equals and add that in there. Does that help? I think I think I pulled this straight out of the textbook, and quite honestly, yeah, I like seeing it written slightly differently than this. So I'll add that down below there and upload the revised formula sheet. By the way, if there's anything else that I'm missing that you think should be on here, I'm always happy to take suggestions. And I can't put everything on the formula sheet, but I'm open to reasonable suggestions. Anything else? Any other problems, Alex, that you had?
I guess since we're in chapter 6, number 9, I used that formula,
Mm-hmm.
and it only worked for the second part of the answer and not the first for some reason.
Okay.
I used the same exact formula for both.
Let's see. So this is it right here? Hank's Barbecue just paid a dividend. Is that right?
Yeah, that's it.
Okay.
I don't think you have to go through the. I don't know. I think it might just be an error on my end, but
If the required rate of return is 11.5%, what is the value of the stock? What if the required rate of return is 16.5%? So we've got they just paid a dividend. Dividends are expected to grow at 13.5% for the next 5 years. So, and then that immediately tells me we're dealing with a two-stage model. Level off at 8.5% indefinitely. And so if our K,
I guess there's nothing different you'd have to do for one or the other, right?
No. In fact, if you look at the and by the way, do you guys get to see this explanation once you've completed the problem? You do. Okay, good. Here we've got, remember that first part of it is always just like the constant perpetual growth version of the DDM. So we've got that next dividend. So it's $1.95 grown at that 13.5% for the first 5 years, divided by K minus G. So there's the 11.5 minus the 13.5. Obviously, that's going to give us a negative number, but because we're in a two-stage model, it's okay if that first period comes up as a negative. And then do the fraction here, 1 minus 1 plus the G over 1 plus K raised to the 5th. And then you're plugging in,
Unknown caller.
Then you're plugging in, again, your 1 plus the growth rate from period 1 divided by 1 plus the cost of capital raised to the 5th, and then multiplying it by, again, something that looks a lot like the constant perpetual growth version of the DDM. So there's your 195 is your dividend, grown at this time only at 8.5%, and then you're dividing by that same K minus your G2, your 8.5%. So maybe, my guess is that it may just be, calculation error, because there's so many spots to make an error here. I would say, one thing I would say, I allow you to have a piece of scratch paper. So particularly if you're working something like this, use that scratch paper and write down those interim values. Make sure you're really careful about order of operation, so that always exponents first, and then multiplication and division, and then finally addition and subtraction. And if you follow those rules really religiously, you should be all right. There again, too, given that you've got extra time, this would probably be the sort of problem that once I get done, I'd make myself a note to go back and double check that math. I wouldn't double check it right then and there, but I would jot it down and come back to it, because I always find, again, this is just personal experience, but oftentimes that's translatable. I often find that if I make a mistake and I go back and check my work immediately after, I make the same mistake. But sometimes if I've stepped away from it and then come back to it, I'll see the mistake. So just to, for whatever it's worth, you've probably already figured that out though anyway. You've taken enough exams up to this point. Yeah, I wouldn't worry too much about that one. My guess is that it's a calculation error. You followed the same formula?
Yeah, I think, well, I did it in Excel and I even copied the formula, so I don't know
Yeah.
where the issue was, but.
Well, it could even have been in Excel and in rewriting it that, order of operation got mucked up a bit in there too.
Yeah.
Yeah.
I just wanted to make sure there was nothing different between them, so.
No, nothing tricky. The only change is, here we're putting in the 16.5K instead of the 11.5K.
Yeah.
And that just goes throughout the entire problem. Yeah.
Thank you.
Sure. You're welcome. What else? Anything else that you all have? Got a note to add those video links for the lockdown browser, and I'll give you my phone number for any problems you encounter during the exam. I'll be around. And then, of course, even today, if something else comes up, shoot me a quick email. If it's something relatively simple, I'll just email back the response. If it's a little more complicated, I may ask you we could set up a phone call or a Zoom. So I'm still available the rest of today. And then anytime tomorrow should be, let's see, I don't think, let's see what my schedule looks like. I thought I had something set up tomorrow. No, I'm available all day tomorrow as well. And into the evening. So if anything should come up, we can always address that as you're finishing up your studies. Brandon, any questions that you have still at the moment?
So I'm still going through everything. I don't have anything right now, but
Okay.
regarding the test setup, I'm sure this question was probably asked before I joined. How's the test setup going to be like?
Somewhere in the neighborhood of 60-ish multiple choice, and then 15 plus or minus matching.
Okay.
And that'll be it. I used to, when we were face to face, I would have actually had a couple of big problems that you worked out and showed me all of your work. But in this environment, it just doesn't make sense. I tried it at one point last summer, I believe, and it was just too big a mess. I even tried having, spreadsheets available, but there were too many technical issues. Somebody was on a PC and it didn't work, or on a Mac, and so I just dropped that option. So just multiple choice and matching. Mm-hmm. And on the multiple choice, about half and half, conceptual versus problems. And most of this will look a lot like what you've seen on the homework already. Well, I will let you all get back to studying if you don't have any last minute things. And like I said, feel free to reach out and email any questions. And Claire, I mean, I don't know where you're at in your studying. I don't want to interrupt studying, but if you do want to try to work on getting that BMC set up, we could do it right now, or we could just wait till the night of the exam, or whenever you have spare time.
Could we set something up maybe Tuesday?
Okay.
Wednesday?
Yeah,
Actually, forgot about it.
that'd be fine. Yeah, just keep me posted. Yeah, I'd rather have you work on studying for the midterm. That's much more important. Okay, very good. All right. Happy studying.